Welcome to Market Matters. Today is September 7th, first Tuesday of September. Lots of things going on, so I look forward to bringing everyone up to speed on what we're up to. So for the agenda today, we've got a little bit of a different agenda. As you know, we like to try to bring in speakers or subject matter experts that we think are speaking to topics that are on the minds of a lot of clients. And today we've asked back, and she has agreed to bring back Paige Adlington. She is a senior consultant from Charles Schwab. And later on in the program, we're going to talk about current trends in cybersecurity and some best practices around that everyone could follow. So we're going to get to first, though, the economic update. Then we'll talk a little bit about how that is influencing our investment outlook. And then from there, we'll get to Paige. From an economic perspective, I've showed this chart before, but I think it does a pretty good job of capturing where we've come from more recently and likely where we are headed. This is a chart, obviously, from Goldman Sachs and their economics department. The reason why I wanted to show this is because it does give a good picture of what the consensus view is, meaning what does the average of Wall Street think is going to happen from an economic growth standpoint for 2021 and also for 2022. And as you might be suspecting or might seeing here, after we get over the Q3, this is the pig and the python analogy I've been using for a while now. Once we get through Q3, then economic growth looks like it will decelerate pretty dramatically down to the more trend or normalized level that we had pre-COVID. And that is, just for reference, in the US, somewhere between 2 to 2.5%. I think that's really what both Goldman and the street is forecasting. Why is this really important note? Well, I think if past is prologue, coming into a we've recently been into an accelerating growth scenario coming into Q3. Once we get through the end of Q3, we'll be on a decelerating growth trajectory, and that does have some risks attached to it that aren't really in play at the moment. So, really, one of the biggest risks, I think, is that there's a risk of a monetary policy mistake conducted by either the Fed or European Central Bank or Bank of Japan. And so we just need to make sure we're being judicious about decisions that we're deciding to place capital based on some of the deceleration that's likely to occur. On the horizon as well, we do have some historical changes to capital gains and tax rates. You can see here it's nicely summarized by a chart I grabbed from the Tax Policy Center with a few notable bullet points. One is it actually shows you the progression of a few things. One is in the dark blue line, income tax rates over time since 1960. The yellow line, or the, I guess, burnt orange line, is corporate tax rate since 1960. And then the light blue line is the capital gains rate on top income earners. You can see that I think the big one that's likely to change on the other side of this tax package that's being pushed through Congress is the capital gains rate. I know that's got a lot of clients asking questions and how we're preparing for it. And I think the best way to prepare for this now is really to start making preparations this year during a period of certainty as we enter into a period of a little bit more uncertainty around what this is going to look like. So that's utilizing the lower rate this year and changes that potentially could be made next year, maybe accelerating those into this year, particularly if you're talking about maybe selling concentrated positions or things of that nature. So we'll see what that brings. The good news, though, is that on the COVID-19 front, there's been some data to suggest recently that vaccination is working as designed, despite a lot of what stories might be read in the media. I think this chart does a great job of summarizing. This is put together by the nonpartisan Heritage Foundation out of DC. And you can see here, I think, really when vaccines are administered, the risk of hospitalization goes down dramatically, and the risk of death from COVID-19 drops to almost the same chance as being struck by a lightning bolt. That's a pretty low likelihood. And that, I think, bodes well for uptake, increasing uptake as we get further into this vaccination program or cycle, because as you see on the next chart here, we're getting actually pretty close to some escape velocity, as I would call it, to reaching a fully, at least with one jab, as the Brits call it, to the total world population by November. So if current trends and vaccination rates are to be believed, I think this is data from Bank of America, then we should be at a total global vaccination count by November 1st. And this would, I think, bring some much needed certainty to help investors kind of think about what 2022 might look like. And so that might be an upside surprise that a lot of folks probably aren't necessarily contemplating at the moment. But I think by and large, the economic backdrop continues to look pretty strong. And so with that as a backdrop, how are we viewing the investment landscape? Well, not too dissimilarly to the last time we showed this chart. We still have, as you can see here, we've got the major asset categories here listed on the left, and then a less attractive or a neutral or more attractive rating attached to each one of those. You can see over the course of this year, we've actually downgraded by and large the whole fixed income segment, whether it's across government bonds or high quality municipal bonds, junk bonds, or emerging market debt. That primarily relates to valuation and the fact that most bonds are not yielding what the rate of inflation is right now. Nowhere close, actually, with inflation running at 5.4%. But that's not to say that bonds don't play a role in the portfolio, which we'll touch on here in just a little bit. It just means in our mind that bonds should probably likely play a more reduced role than they have at any point in the last 5 years. US stocks, we still have a preference there for larger companies and mid-cap companies for that matter. Still have a preference for developed market international companies because they do bring some much needed diversification if you can find an attractive active strategy. But more recently, after Q2, we did downgrade our thoughts on emerging markets. That emerging market downgrade actually was well timed because, as you may be aware, the Chinese government has been putting in some sanctions against state-run companies and Chinese companies that have listed in foreign exchanges, and that we've avoided almost all of that drawdown in Asian markets. But we did still have a preference for alternative strategies, whether they be public strategies, public alternatives, or private alternatives, or even things like real assets, which would encompass things like infrastructure companies, treasury inflation protected securities, commodities, things of that nature. And then generally speaking, here are just a few notes. Since the last time we spoke, I believe this was, it's been about 2 weeks since we last, or since we had a rebalance, but we did undertake a more targeted rebalance across a number of different accounts. Now, everyone's may have a little bit different experience when we're doing rebalancing, but by and large, it was driven by price targets that we had on the S&P, and those have worked, I think, quite well for us over the last few years. And one thing that we did do as a result of that was increasing our portfolio liquidity, which essentially means raising a little bit more cash every time we do a rebalance, which I think is the right answer into a very low volatility equity market and as well a low volatility bond market. On the equity side, we still continue to maintain our positions. We are using the volatility or valuation disparity between those companies that we follow, whether they're individual or active mutual funds or ETF strategies, to make subtle changes here and there, but we're not making massive changes within the equity portfolio because we still think that there's a balanced risk and return outlook, particularly for active strategies. The Chinese crackdown is something we definitely need to keep an eye on because that may present an opportunity. We know, and I'll show you in just a moment, the depth of the drawdown that the more recent crackdown caused on Chinese stocks. But we should also now pivot to the other side of the coin, which is, well, maybe we should start looking for the opportunity now to gain some exposure there at some point. We're not there quite yet, but we're actively looking. Our fundamental belief, however, through the end of the year is that, and probably into Q1 of next year, is that a combination of both momentum in the stock market plus some stock buybacks that are at very supportive levels will probably propel stocks through positive territory into year end. Fixed income, we still are keeping a relatively short and high quality position within fixed income. This is really meant to preserve capital. That's the idea. And inflation is still a big question mark. So we want to make sure that we're adequately balancing the risk and return within fixed income, because of course, if fixed income or if inflation becomes a bigger problem and sticks with us for a period of time, longer than a couple of months or quarters, then fixed income might get dinged up pretty badly. So we want to be ready to act on higher rates if and when they do come. And then finally, we are, very still pretty positive on our alternative strategies, as I mentioned, where we've got some nice outperformance within those strategies. And then also, we're actively evaluating ways to get exposure in the digital asset realm. And there's more to follow on that in subsequent webcasts that we'll have. So here's just a picture of where we are with global stocks so far through September 3rd. This is last Friday. U.S. stocks continue to lead the way higher. We've got U.S. stocks, the S&P up almost 22%. It's off a little bit from today, but still, that's by every stretch of the imagination. This is a really strong year for risk markets and equities in particular. The Russell 2000 small caps have actually, as we pointed out in previous webcasts, have been in this sideways trading range. We're now, whereas they jumped off to a really early start, galloping ahead of every major market earlier in the year, have really traded sideways. And I think we're looking for small caps to try to regain some of that leadership within the equity markets, because they tend to be much more economically sensitive. And I think this Russell 2000 index will be a good tell for us. International stocks are again, by all stretch of the imagination, having a pretty good year as well too, up 14% so far for developed markets. That's certainly nothing to be sad about or be downtrodden about. Just giving us a little bit of a different exposure here, even though it's not quite keeping up with the S&P. And then emerging markets, as you all know, we've not had a very large emerging market exposure. When this index actually went negative for the year, our small weighting into the emerging markets is through a active mutual fund, and this position has actually done quite a bit better than this so far this year. Still not as good as the S&P, but I think our weighting decision to remain cautious on these markets has certainly been beneficial to our portfolios. And this is what I was talking about with, while markets tend to be driven by earnings, one way that you can generate earnings is obviously through net income. The other way is to reduce the share count on which those earnings are measured. And so that's where stock buybacks come into play. So you can see right here on the screen, a look at U.S. stock buybacks going all the way back to 2000. And 2021 is shaping up to be a near record year for buyback authorizations this is to the end of July. So, if financing rates and bond yields stay low at this level, we could expect, obviously incremental more buybacks through the end of the year. And I think this will help sustain some of the earnings momentum that we're seeing right now. As corporate buyers see stock buybacks as a significant way to try to increase shareholder value, and therefore they should represent a significant source of demand for stocks in the future. And then of course we still get questions, and I'm sure that's on a lot of people's minds, is kind of the "are we there yet" question. Have we heard the bell yet of peak market? And I think the answer is no. One of the main reasons, I think, is what you see on the screen here in front of you, is the two measures of sentiment. One is the Bank of America Bull Bear Indicator, which has historically had a pretty good track record, as well as the CNN Fear Greed Index, or Greed Indicator. And for each of these data series, when you get an above the red line on the top, that means you're in extreme euphoric conditions, and if you get below this red line on the bottom, you get into extreme pessimistic territory. Same thing for the CNN Fear Greed Index. And so I guess one of the takeaways that I look at when I look at both of these charts is that investor enthusiasm is certainly not euphoric right now. I mean, yes, there are markets are at all-time highs, but we're not in a place as we might be or had been in the year 2000, or even in 2007. There's just not euphoria right now in the markets, and I think that's something that is going to help us grind higher and climb that so-called wall of worry. Another measure of investor enthusiasm is, as you may have read about with the Wall Street Bets crowd or the Reddit crowd, the options markets, because the option market is another way we can tease out and see if people are being greedy or fearful. So just a way to read this is the CBOE put call index. A reading of 1 means that equal amounts of calls are being purchased as puts. If this line is, if we go above 1, that means that more puts are being purchased than calls. And just to give you an idea, a call is an options contract that gives you the right to participate in the upside of a stock. And a put is a options contract that gives you the right to, I guess, not participate if the stock goes down. So it's an insurance, in other words, below a certain point. Anywhere between this, 1.1 to 0.8 is kind of a neutral reading on this index, and I think that's exactly what you're seeing. Yes, there have been times over the last 2 years where we've gotten or dipped below this 0.8, but I would say all things being equal, we're now at a more level reading for this put call index, and that is not giving us pause that there might be some significant trouble on the horizon quite yet. Moving on to this next page. One thing that I do think will also keep stocks bid probably for the foreseeable future is what you see on the screen right here. So this is the yield of the S&P 500 over time, going back. Actually, it's the SPY. It's the ETF that tracks the S&P. And what you notice here is that we're at levels that we actually didn't get to until I think it was 2003. Last saw 2003. Current yield on the S&P is at 1.23%. But we also have to recognize that bond yields, particularly on the 10-year Treasury, is at 1.34, and that's not a huge difference. The big I think positive for stocks though as well too is that that yield will grow over time, whereas a bond yield will not grow over time. It's a fixed rate. And I think this is one thing to suggest that yield is becoming more scarce, and therefore investors will likely continue to pursue equities as one of the main ways that they find yield in the markets right now at the expense of bonds, and therefore will likely keep stocks well bid for the foreseeable future. Moving on to international stocks, I did show this chart the last time, but I thought it was worth revisiting because there may be some change afoot in front of us. But this is a year-to-date picture of the S&P 500 performance in black versus the Chinese top Dow Jones 50, if you will, for the Chinese market here in blue. And obviously some diametrically opposed returns. The gap in returns is about 30 percentage points so far. But you can see here, after a pretty sharp sell-off in the latter part of July, which is when the Chinese government nationalized education companies, it's really been trading choppy in a sideways motion for some time. And that might mean that the worst is behind Chinese stocks. Don't get me wrong, we're still not necessarily adding to the sector because I think there's still a bit more value that we would like to see before committing to things like Chinese stocks, but certainly something that's grabbing our attention. And one thing that would make us a little more interested is if maybe we got another 10 to 20% down in Chinese stocks. That would be something worth paying attention to for sure. Let's turn to fixed income briefly. You can see here what's happened. This is over the course of 2021. Still the same things that have been in place have been kind of working in the same direction. High yield bonds have really been leading the way forward. But remember, high yield bonds are really more of or junk bonds are more of an equity proxy as opposed to anything else in the bond market. Emerging market debt finally pulled positive for the year, this is really interesting. Investment grade US bonds and government bonds still kind of lagging or languishing, as I would say, down here at a little bit of a negative return, but it's gradually working their way back to a break even for the year. And I think you may recall back in March, April, that was kind of our base case, was that bonds would likely grind back to that break even level, which it appears that's happening. One way that we think that would happen, and particularly for our portfolios, a lot of our strategies in fixed income now actually are showing a positive return, is because, as you know, we use a lot of active strategies that have been working quite well in some cases. So we're pretty happy with the way the bond portfolio of our sleeve has performed this year, and we think that there's still some good things to come from that perspective. And I think this is just one reason I wanted to show this chart here is that this is a chart showing the yield spread of the investment grade bond universe, triple B bonds, to treasury rates. So this is just the difference in yield between a triple B bond and the U.S. Treasury note, which is triple or double A, highest credit quality. You can see that spread has come down quite a bit since 2020. This is over the last year. But really, why I wanted to share this chart was that bonds have really been trading in this kind of very tight 10 basis point trading range for the better part of the last 6 or 7 months. And I think this is really just insinuating or noting that bond investors aren't necessarily very fearful of what's going on right now, either with inflation or the equity markets in particular, or the economy for that matter. And it's really just emblematic of, I think, a settling in that's occurring within the bond market that's, I think, just providing some low volatility context to invest around. But we want to be ready, as my point, to make sizable investments in the bond market when they do show up, which could be at any moment. So just some key takeaways before we get to Paige and our guest speaker. One is, again, a lot of these should look pretty familiar, but we still favor stocks over bonds, and that effort started earlier this year when we recommended an upward allocation to stocks across most clients. But we have started to reposition some of the equity positions ahead of any tax changes, taking advantage of some of the lower rates potentially. And I think that's worked out well so far in concert with some of the rebalancing activity that we've done. We still favor alternative strategies over bonds right now, particularly with bond yields where they are. We think there's other things to do to improve not only the yield component, but also the diversification component. As I mentioned, looking at things like digital asset strategies late 21 or early 22 would be something of a priority for us as well to nail down. The other thing I would note here is that we are preparing for higher volatility, and that usually means that all is quiet in the market. So we're looking for opportunities to take advantage of that volatility through our rebalancing process, but also some selective changeouts. And then also, incrementally raising cash, as I mentioned, that's just a byproduct of the rebalance process. And I think that, that's just a prudent portfolio management tool to utilize when all seems well with the world. One question here before we get to Paige is, do you expect corrections for the remainder of the year, or what about debt? Are we even paying any interest anymore? So corrections to the remainder of the year, that's very difficult to understand what's going to cause that. There's a variety of things that could happen between now and the end of the year. So I'm not necessarily, don't have really thoughts on that. And then debt or debt levels, when is that going to be a problem? That is a common question that we've had over the years. And I think, one of the tells that we have for whether or not debt's going to be an issue is if, the currency, the US dollar, starts to decline pretty dramatically versus our trading partners. Until then, it's really hard to get too negative on the debt market, because that's one of the best telltale signs that all's not right. So with that, we're going to bring back on, you now see on camera, someone that we had on, I believe it was about a year ago, if I'm not mistaken, Paige. So thank you for revisiting our platform here. And this is obviously a topic that I think is on the minds of more so for clients as well, because of all the higher profile situations we run into with cybersecurity or things we read about. So I thought it was very timely to have you back on. So thank you for joining us.
Thank you for having me.
Yeah. So we'll just dive right in if that's okay.
Yeah, let's do it.
I was just going to say, can you just give us a quick update on recent developments within the cybersecurity space, and maybe a couple of examples of some notable issues that have been experienced by companies?
First, I'll just double check. Can everybody, or Todd, can you hear me okay? So then I know the audience can as well.
I got you. Yep.
Okay, perfect. So Not a big surprise here in what we're seeing happening. It's really about it exponentially increasing. And what I'm talking about is like those known threats. So where we think about phishing attempts, where people are sending you emails wanting you to click on things, social engineering, there's just a noticeable and sizable increase in that. And as a result, we're seeing data breaches where we historically didn't. Now, some of my counterparts attribute it to just people targeting these institutions, but I actually really correlate the increasing that's happening because of the work remote policies. And when I say remote work policies, the idea that so many folks are working from home, and not only working from home, but students are at home. So if you look at it, families are at home, even blended families. And what happens then is you get use of computing systems that doesn't usually happen. So you have children using parents' computers. You have grandparents using parents or their adult children's computers. And then what happens is they go into systems, they're checking their email, and then all of a sudden there's a very blurred line between what happens at work and what happens in your personal life. And they're leaping over into each of those areas, including leaping over to, where I might potentially feel comfortable logging into my bank account on my home computer, but now I'm working from home and my 15-year-old's also been on there, and what have they downloaded to my computer? So definitely an increase on those types of activities. Still an increase in identity theft. I tell folks that you, at this point, not only in COVID, but in a cyber environment, you just need to assume that your information is out there. You need to assume that everything to build your identity exists in the environment. And what you need to do is protect yourself against people using it. And so by staying vigilant around things.
Got it. Got it. Yeah, it's kind of, I guess it's kind of a new age for a lot of us to come to terms with, right? There's no such thing as privacy anymore. Um,
Absolutely.
so, obviously, Schwab is one of our biggest and best partners that we work with. Most of the clients on this call likely have assets custody with Schwab. Is there anything Schwab is doing to help address some of these issues that you're discussing right now? Because I'm sure to some it feels a little scary.
So I'll start from just my own personal work environment. So at Schwab, yes, we still have a lot of folks working from home, cautiously, returning to the office with respect to our clients and to staff. But I will tell you the increase in security on my laptop is exponential. I think if you look to your corporate partners or you look to Gratus and those that are working on your behalf, you will see an increase in technology usage. You will see an increase in monitoring rules and policies. I've worked a lot with firms over the past year on how do we set and establish the best remote work policies we can to ensure that clients are safe. And that's exactly at Schwab as well. I literally cannot do pretty much anything from my company laptop at this point except log in. I can't even go to the internet without having a VPN enabled. So that's where I'm seeing not only Schwab being really robust about that, but also advisors in this space. Additionally, I'm seeing advisors be really cognizant of letting their clients know what they're doing. So what is Gratus, what are they doing to help you be safe? Being really transparent in what they're doing to be vigilant on your behalf, making sure you understand why those questions are getting asked or why that extra phone call is being made. It's not just because it's what they want, but I will tell you that there's an increased diligence on Schwab's part to, has that client been called? Has that been verified? Do we know that those are the correct account details for perhaps like transferring or buying a new asset? I'm being really vigilant on that side. And then lastly, just training. We consider it a responsibility and also to best serve our clients if that we educate you, and that is educate advisors, educating the market, making sure that people have resources and tools available to them to make themselves feel safe. So, from our perspective, we're always here for people to ask questions. You can certainly go check out on the Schwab website, the Schwab Safe Guarantee, which outlines what we're doing with respect to keeping you secure.
Yeah, thanks, Paige. Yeah, I know we at Gratus have spent a lot of time thinking about how to make sure we can maintain that security umbrella, if you will, not only on the behalf of clients, but also for our internal systems as well. It's a really critical and only growing more important, I would say, as well by the day. We're not getting the Nigerian banking emails anymore.
Oh, no.
It's coming in different ways, like really cleverly disguised emails that look like they're coming from a friend or, even coworkers. We've seen some of that.
Yes.
Well, that's, great context. So I think I've outlined, we do at Gratus have some ways that we're managing this, but if you're a client sitting at home, what would be some of your suggestions as to things they could do to, as you say, be more vigilant and protecting their identity and information?
So I don't think I can say it enough that email is the biggest threat to anyone. Email is the biggest cybersecurity threat that exists out there. So the first thing I always reiterate whenever I'm talking to anyone, and you guys especially, and I know I probably said the exact same thing a year ago, is passwords. Have a very, very robust, lengthy, complicated password. Keep those unique to websites. And certainly where it exists, enable or make use of two-factor authentication or that dual factor. Over COVID, we have seen individuals as well as businesses and small businesses try to embrace new technology or maybe cloud application services out there. But what they fail to do is look into the security of that application. So if, let's say, I had lots of folks go to Office 365, I use it personally, it's a great product. The number of threats or potential breaches we saw related to compromised emails for Office 365 was really related to very simple passwords and not enabling two-factor. So I'm always gonna, that's gonna be my big preach to the choir is have a robust password and really enable two-factor, and throw in using those password managers are a good idea. The other thing I really want to stress this year, and this will make me sound terribly nerdy, but that I get really excited about talking to folks now is, as we're all getting really used to over the years, understanding how we need to protect ourselves against cyber threats and maybe even detect them. But what people don't realize they really need to start focusing on is how do they respond? So how do you respond personally and from a business perspective? How do you respond from a potential breach or being notified, and how would you recover from that? The easiest example I can tell you lately is, if you haven't noticed on the news, I think in any city or state that I work with, school districts are having data breaches. And everybody's like, oh God, they've gotten my schools, who cares if they've got my kids' grades or school? But I'll tell you that the reason that they're going after school district is because of passwords. So if you find out that your school district is compromised, people are like, it's no big deal, but they don't really care about seeing your child's or your grandchild's, school records. What they want to do is try to figure out what your password is so they can go use it someplace else. So if you hear that, how do you respond? Or if you hear that we've heard these leaks, the different credit monitoring services. So if that happens and you're part of it, what do you need to do? The best example is I have one of the Schwab relationship managers that I work with. She called me over the weekend or texted me and said, do you have a second to talk? I was like, sure. She said, well, my dad just called. She's like, he's usually pretty good. He's a smart guy. He was a CEO of a company, but his email, his Yahoo has gotten compromised. So what does he need to do? And the first thing I said, well, has he changed his password yet? She's like, I don't know. I said, well, the first thing you need to do if you find that out is go change your password, and then go change every password you have on every financial account you have. So you need to, in your mind, have your own personal, what I call respond and recover plan in place.
Got it. Yeah, it's sage wisdom. Yeah, I hadn't even thought about the school situation because now we're getting all of our grades and report cards through electronic delivery. That certainly is a known, probably vulnerable point. So it's hits home for me for sure. Um, well, great. Paige, we've kind of taken it to the end of our time here. Do you have any final thoughts before we part ways for today?
No, I would just, tell everybody stay vigilant. The things that you've heard about, they just continue to increase. Um, if you have any questions, I always say if you have any questions about somebody you have a financial relationship with, or somebody that maintains confidential information, a CPA or lawyers, don't be afraid to ask them what they're doing to protect your privacy and your data. I think people got really nervous about asking these types of questions over time, but really in this day and age, and with the number of relationships you have that are working remote, I think it's completely within your trust and confidentiality with that group or organization that you're partnered with, to ask them the question. Let them know that it's important to you, and then also be open to what they want to do to make you safe and secure, and that they're trying to do the best for you.
Great. Yeah. Thank you very much
Mm-hmm.
for that. Well, Paige, thanks so much for joining us today, and maybe we can have you on in another year or so to bring you
Yeah,
back for some updates that
I know.
in this ever-changing landscape we're in.
Yes. Hopefully it'll be in much more environmental better circumstances.
Yeah, let's keep our
Yeah,
fingers crossed.
exactly.
Well, great. Thanks, Paige. I think that'll do it for this week. So, everyone, thanks again for your time. We'll talk to you again sometime soon. And thanks again, Paige.